The capital investments we make have very long timelines, 25 to 30 years or longer, and in fact, many bridges exceed 100 years. This requires us to base investment decisions that we're making today in an environment that we expect to face over the long-term future. The board must also take a long-term view, must be wary of providing short-term gains for some at a cost of undermining the industry's ability to make investments that are needed to help create a better future for our industry. Where policy judgments must be made, you should not take chances with the nation's transportation future. You should resolve doubts in favor of more rail infrastructure, not less. Your decision in this proceeding will directly affect how much investment is made and thus how extensive or how limited our rail system will be to address the challenges of the 21st century. In conclusion, if you believe, as we do, that the demand for transportation will continue to grow and that investment in the rail industry will serve the public interest by providing needed transportation capacity, helping our country reduce its dependence on foreign energy, improving air quality, and improving our global competitiveness, then you should be acting to increase the flow of capital to the railroad industry. Thank you.
Thank you, Mr. Young. I think we'll now go with Mr. Romig from the Norfolk Southern Railway.
Thank you, Mr. Chairman. I'm Bill Romig, Vice President and Treasurer of Norfolk Southern Corporation, and we're glad that the board has allowed us to present our views this morning. Norfolk Southern uses both CAPM and DCF to estimate its internal cost of capital. And we've done so for many years. And we use an average of the two. And we find that the results are relatively close together. However, when we do that, it's useful sometimes to think about what we're trying to estimate. Both of those try to estimate the cost of equity. And what is the cost of equity? Well, it's what an investor expects when invests in a stock that's similar in riskiness to your own stock. And sometimes the technical details of estimating the cost of equity obscure that fundamental fact. And I think we've seen that in the testimony here this morning. What is it that the investor wants when it invests in a rail stock? Well, if you look at market returns over the last 100 years, Ibbotson has a series that show that the average stock, that's the stock of average risk, has returned 11.3%. And the S&P 500 over the last 50 years has returned 10.6% to the average stock. Now I ask the question, would you invest your money in a stock which returned only 8.4% if the average stock returned substantially more than that? I think if you were an investor, or if you were thinking about investing your own money, or you were investing others' money as a fiduciary, the answer to that would be no, that 8.4% is not an adequate return on equity. And that's our fundamental concern about what the board has done to date. And we would suggest, as have some of the other experts here, that a more market-based rate is appropriate. Revenue adequacy should be a floor and not a ceiling if you are interested in the long-term health and profitability of the rail industry. Now, having said that, let me comment a little bit about replacement costs. When Norfolk Southern prices traffic, we price to the market. But when we do that, we want to make sure that that price clears our cost hurdle rates. And the cost that we estimate in most cases includes replacement costs for freight equipment and replacement costs for locomotives. And we do that because we buy locomotives every year and we are replacing freight equipment. However, if we have to defend that cost, sometimes we're allowed to use replacement costs in a standalone cost hearing. Sometimes we're not allowed to use replacement costs as in an IRCS cost basis. And so I think the board needs to think carefully about whether replacement costs in certain settings is an appropriate way to look at railroad returns. And with that, I would conclude my remarks, and thank you for listening.
Thank you, Mr. Burrows.
Thank you, Chairman Nottingham, Vice Chairman Buttrey, and Commissioner Mulvey. My name is Michael Burrows, and I am Senior Vice President and Chief Accounting Officer for the Kansas City Southern Railway. KCSR appreciates the opportunity to present today its views on the board's proposal. In keeping with KCSR's previous comments in the proceeding, The focus and purpose of my testimony will not be to rehash and discuss the relative merits of the various methodologies for calculating an industry-wide average cost of capital. The board's discussion with the previous panel seemed to vet that out pretty well. Instead, KCSR's focus will be on how cost of capital is intended to be used by the STB in future proceedings involving KCSR and others. Currently, it's our understanding that regardless of the methodology selected, the STB intends to calculate an average cost of capital based upon inputs from the 4 largest Class I railroads, and then apply that average to KCSR's cost of capital. KCSR strongly urges the board not to adopt such an approach. The record has consistently reflected, and no party has really credibly disputed, that regardless of the methodology the board may choose to employ and the inputs it includes in the methodology, the use of an industry-wide average will understate KCSR's cost of capital. One distinction is that the largest U.S. Class I railroads, whose economic data is used to compute this industry average, are all investment grade in the marketplace, where everyone competes for the same resources. Like many rail carriers, other than the largest Class 1s, KCSR is not considered investment grade. KCSR's cost of capital, quite naturally, then is consistently higher than the industry-wide average proposed by the agency. The application of the industry average has always understated KCSR's cost of capital. Now it will have a detrimental impact to KCSR and other similarly situated railroads. An example, in a rate reasonableness proceeding, application of the new industry-wide average would result in a rate prescription that would understate KCSR's actual revenue requirements and restrict KCSR from the opportunity to achieve appropriate revenue adequacy. We believe that to prevent these unintended harms from occurring, KCSR is urging the board to permit KCSR and other similarly situated railroads to substitute an individual cost of capital versus the calculated industry average. Of course, it can't be determined at this juncture how the board would calculate an individual cost of capital until we settle on a methodology for use in developing that average. Once that's determined, it's likely the board would be able to use the same methodology, applying, for example, appropriate KCSR-specific inputs to calculate an individual cost of capital. If that later required KCSR to provide additional data or information reporting to the board, KCSR would be happy to comply with whatever requests were necessary. Alternatively, the board at a later stage could also take comments on that issue. In making this request, let me be clear, we're not asking or seeking to manufacture any kind of artificial distinction between KCSR and the other carriers. Rather, we seek board recognition of the realities of the capital markets in which we all operate and believe that recognition is necessary to avoid an unintended regulatory bias against the KCSR and the board's use of an industry-wide proxy. As I understand, it is true that to some extent KCSR has been exposed to this issue ever since the agency first began using an industry-wide average. However, the issue never manifested itself directly from STB board actions. Even if the issue had come up, the prior guidelines allowed carriers to make movement-specific adjustments to IRCs, which essentially compensated for an understated cost of capital. Now, with recent rulings eliminating the ability to make movement-specific adjustments to IRCs, and with the adoption of simplified rate guidelines, it's critical the board consider the impacts of using an industry-wide average in its final determinations. As I begin to close, the Kansas City Southern Railway is clearly aligned with the board's goal of moving to an appropriate cost of capital calculation. Once the appropriate methodology has been developed, KCSR and others should be given the opportunity to input key differences and not simply required to use an industry sample. Finally, count on KCSR's commitment to work with the board as needed to achieve that result. In closing, again, I'd like to thank each member of the board for allowing me personally to represent KCSR and for allowing KCSR this opportunity to articulate its views. Thank you very much.
Thank you, Mr. Barrows. Now we'll turn to Mr. David A. Bohr from the CSX Transportation Company.
I have some slides. I'll just bring them up. So they're on the screen there, and then there's a clicker. It's up here. I'd like to thank the board for the chance to come and amplify the written comments that CSX already submitted. In our written comments, we concluded with a recommendation that the board should retain the existing DCF methodology, or in the alternative, If we were to make a change, we need to do so holistically, considering the issue of replacement costs. I know there is a real desire and a need and compelling need to move ahead and to get through this. My goal today, really through the 9 or 10 slides that I have, is to try to make clear why CSX's recommendation to do this holistically is both sensible and responsive to the board's mandate. The decisions that come out of the hearings today really can't be cut short. They are tremendously significant to the industry. I know the board is very well aware of the public policy benefits of a strong rail system. I think all parties also agree that investment in rail assets is ultimately going to be determined by the expectations, the long-term expectations of returns to investors. The point was made earlier by Mr. Young, and I endorse it as well, that it's not just new investment that we're talking about and growth investment, which is vitally important to the railroad industry. It's also replacement capital. It's also affected by these decisions. So the primary impact of the matters that we're talking about today will be how they affect the ability of railroads and shippers to privately negotiate freight rail rates. Any change to the cost of capital cannot be divorced and isolated from an examination of the underlying investment. I hope to make that clear with some of the later slides that follow. For CSX, reinvestment in the business is very significant. It's a primary use of our cash flow. We invested $1.7 billion of our cash in 2007 back into transportation assets. We spent over 80% of our cash flow from 2004 to 2006 reinvesting in the business. We've got to earn sufficient returns to be able to continue that. $1.7 billion is in the range of that which will continue, as you see on the slides, ranging from 1.6 to 1.7 over 2010. Year after year, that type of investment requires a strong ability to get earnings to justify that return. For a little bit of perspective on the nature of that investment, I've provided some pictures in case you haven't had a chance to check the price of rail assets recently. Here's a little bit of an update. Coal cars are running about $65,000 apiece. That's a 30-year asset. Locomotives are nearly $2 million each. That's also about a 30-year asset. New track, excuse me. New track is running $1 to $4 million a mile, depending upon terrain. And in the lower right-hand corner, you see a picture of the bridge over the Bay St. Louis that we substantially lost in Hurricane Katrina, which cost over $75 million to build. My point is really this. There's tremendous capital to stay in business. There's tremendous capital to expand capacity. And all that capital is committed up front for an uncertain future. It's subject to the economic cycles and uncertain demand. Hurricane Katrina gives us a unique ability, perhaps, to illustrate some of the chances to see how replacement cost and inflation over time has dramatically affected the cost of book values that are carried for these assets. The Bay St. Louis Bridge, which was placed in service in 1967 at an original cost of about $5 million, had about $2 million of book value, and the cost to rebuild it was $79 million. Little Rigolets Bridge was in that same area, was put in place in 1918, built for $100,000, had no book value on the books. It cost $18 million to rebuild. And that's really the dilemma. It's the nature of rail assets being long-term that is the problem with the revenue adequacy formula. The long lives of our assets means that inflation has a significant effect, and railroading is asset intensive. A replacement cost approach, where inflation is reflected in the asset base, can better match return with cost. And I know I'm about to run out of time, but let me take it just for another minute or two through the example, if I may. I think this will significantly illustrate the point. If we take an investment of $100 million, and it's a 30-year asset life, consistent with some of the examples we've talked about, and it produces a 10% return over its life, so all the cash flows are generating ultimately a 10% return, and has a constant return profile year over year, but for inflation that we will assume will go up 2.5% a year. Then that type of an example produces the following cash flows. So you see on this slide some point estimates for after-tax operating returns. Beginning in year 10 at $5.7 million, they grow gradually up to 9.7. That's the effect of this 2.5% of inflation. There's higher numbers in the earlier years because of some of the effects of tax benefit of depreciation sheltering tax cash flows. The investment base on the second line also declines over time. So when we look at ROIC, or return on invested capital, using these historic numbers, we have a range that goes from 9% to 53% in the outer years. Clearly, the last half of the asset's life, it's generating returns in excess of its real economic return. Finally, this slide is what brings it together in hopefully a way that will